All right, let's talk about your mutual funds. It's easy to feel a little lost sometimes when you look at your statements. So today, we're going to build a simple, step-by-step guide to help you figure out exactly what's going on with your investments. We're going from confusion to total clarity. Let's get into it.
This is the big question, isn't it? You put your hard-earned money in, you see the numbers go up and down, but how do you really know if your funds are doing what they're supposed to? It's easy to get tangled up in all the data. Well, we're going to untangle all of that today.
Here's how we're going to break it down. We'll start with a super practical 6-step checkup for your funds. Then we'll get to the big decision. Do you stay or is it time to switch? And we'll wrap up with what might be the most important part of all, getting into the right long-term mindset. Okay, let's dive right into the main event, your 6-step fund checkup. I want you to think of this as a regular, annual health check for your investments. Simple but really effective. This is our roadmap. We're going to walk through each of these 6 steps one by one. Each one gives you a different piece of the puzzle, and by the end, you'll have a really clear picture of your fund's health. First things first, and this is probably the most important step, you have to ask yourself, why did I invest in this fund in the first place? If your goal was something like long-term wealth creation, for 10+ years down the line, then a few bad months or some scary headlines just don't matter that much. This step is all about remembering your original goal and just tuning out the short-term noise.
All right, on to step 2, performance. Let's use a real-world example here. Imagine your fund has given you a 12% return each year, on average, for the past 5 years. Now, that sounds pretty good, right? But here's the thing, a number like 12% doesn't mean anything by itself. We have to compare it to something.
And that something is what we call its benchmark. For a fund that invests in big Indian companies, for example, the benchmark might be an index like the Nifty 50. So if that index returned 11% over the same 5 years, now we have a real comparison. And this chart says it all. Your fund, at 12%, has managed to beat its benchmark of 11%. This is exactly what you pay a fund manager to do. Their job is to try and beat the market. So seeing this is a really positive sign. It's a big check mark for your fund. Of course, we always have to remember the golden rule of investing. Just because a fund did well in the past doesn't guarantee it's going to do well in the future. But it is a very, very important piece of the puzzle when we're doing our checkup. Now let's move on to step 3, which is all about consistency. And here's an interesting little secret. A truly great fund is hardly ever the #1 top performer every single year. In fact, if you see that, you should be a little suspicious. What you're really looking for is a pattern like this. Maybe it was just average last year, but it was above average over 3 years and really strong over 5. That steady, long-term performance is what truly builds wealth. Okay, step 4 is our risk check, and this is so important. Performance is only half the story. You also have to ask, how does your fund act when the market gets rocky? So if the whole market falls by 10%, a well-managed fund might fall a bit less or about the same. But if your fund suddenly plunges 15% or 20%, whoa, that's a red flag that it might be taking on way too much risk for your comfort. Now it's time to look under the hood with step 5. What is this fund actually investing your money in? You want to see names you recognize, high-quality, reputable companies. And you want to see that it's spread out. You don't want all your eggs in one basket, right? If one company or one sector has a bad year, it shouldn't wreck your whole investment. And for our final check, step 6, we look at the cost. Every fund charges a fee, and it's called the expense ratio. You just need to make sure you're getting good value for your money. So if your fund charges 1% and similar funds charge a bit more, you're in a good spot. And remember, while a fraction of a percent might sound tiny, over decades it can compound into a huge chunk of your potential returns. So we've gone through the 6 checks, we've gathered all the facts, now comes the moment of truth. What's the verdict? What do you actually do with this information?
This slide makes the decision pretty clear. Over on the left, you've got the green flags. These are all signs of a healthy, well-run fund that's doing its job. If you're ticking these boxes, awesome. You can probably feel pretty confident. But on the right, those are the red flags, the warning signs that suggest it might be time to start paying closer attention.
And let's really zoom in on this one, because it's the most important. One bad year? That's normal. Even 2 can happen. But if your fund has been consistently lagging behind its benchmark for 3 years or more, that's not just a blip, that's a trend. And it's a very serious warning sign that something fundamental might be wrong, and you need to take a hard look.
Now that we know the what to do, let's talk about the how to think, because having the best checklist in the world won't help if our emotions make us do the wrong thing at the wrong time. This is all about learning to think like a successful, long-term investor. These right here are the classic traps. Panicking and selling just because of 6 bad months. Or comparing your big company fund to some hot new small company fund. That's like comparing apples and oranges. And maybe the biggest one of all, chasing last year's #1 fund. Today's winner is very often tomorrow's average performer. Just avoiding these mistakes is half the battle.
So let's boil everything we've talked about down to one simple, powerful checklist you can use every single year. Is your goal still the same? Is the fund beating its benchmark over the long haul? Is it consistent? Is the level of risk okay with you? And is the cost fair? If you can answer yes to these questions, you're very likely on the right track.
And this is the final thought I really want to leave you with. A trader reacts to every piece of news every single day. An investor reviews their strategy based on their long-term goals. This whole checkup process isn't just a to-do list. It's a shift in your mindset. It's how you take confident, informed control of your own financial future. And, of course, just a quick reminder, this is all for educational purposes. All mutual fund investments come with market risks, so it's always a smart move to have a chat with a qualified financial advisor. Thanks so much for joining us.